Good morning, everybody, and thanks for joining us for this morning's webinar on investment markets, looking back at 2022 and looking forward to 2023. Most of you know me. My name is Jonathan Sheehan, and I'm Managing Director of Compass Private Wealth. I'm joined by my colleague Robert, who you meet later on in the webinar. Robert is sitting about 10 feet away from me in the office here, so hopefully we both combine to give you a very holistic overview of where markets are positioned currently. We're also honoured to be joined at about 25 past 11 by Ian Slattery, who's a fund manager with Zurich. And we thought it would be interesting to take Ian's slant on the current happenings in markets from the perspective of an actual fund management firm who are managing proprietary funds, and for him to convey what Zurich are seeing on the ground. So just a bit of housekeeping first. So there is a Q&A button within Zoom. So please do ask questions to myself and Robert throughout the webinar. We'll endeavour to answer them either during the webinar or at the end. All questions that you ask are anonymous, so other guests can't see the questions you put forward. This webinar is recorded, so we'll send out the recording afterwards, and we'll also send out the slide deck. So firstly, just looking at 2022, I suppose a roller coaster is the simplest way to describe it. There was a lot of different themes happening. We're very aware of what happened at the beginning of the year in February with the Russian invasion of Ukraine. We're aware of what the central banks had initially said in 2021, whereby inflation will be transitory, and it turns out that that prediction was completely incorrect. So therefore, we saw significant interest rate increases by all central banks throughout the world. Ian Slattery will be speaking a bit about that later on. And we also saw a huge uncertainty in the global economy, dominated by, as I said, inflation, interest rates, and what was happening with Russia and Ukraine. Just a few statistics, three key statistics. One is the inflation number in Ireland in December at 8.2%. Robert will speak about inflation in his slides shortly. The ECB base rate at 2.5% and the unemployment rate at 3.5% in the US. Now, they're just three key statistics. And I'd ask you all just to think back to, let's say we were giving this webinar 12, 18 months ago, and I put those statistics out there. A lot of people wouldn't actually believe them. They would say, how have we gone from up until March of 2021, we had 13 years in Ireland of zero inflation. So for us to be talking about 8.2% inflation as a lower figure than what we've had for the last few months is quite astonishing. To see where the ECB base rates have gone to, from being pretty much negative and zero for a number of years, to this cycle of increased rate hikes in Europe, and for all the bad news that's happened out there, to have still all-time low unemployment rates in the US is quite astonishing. Just some key statistics, and Robert will speak about the market indices in terms of the illustration of how they performed in 2022 in a minute. But just some key statistics: Europe was down about 9%, the DAX in Germany was down just over 12%, the Irish stock market was down about 15%, the US was down 18% in dollar terms, but 12.5% in euro terms, and the FTSE was the strongest index last year, not for geographical reasons, but for sectoral reasons, which Robert will touch on. Other points, we saw a big sell-off in the dollar towards the end of the year, so that finished the year at 107. Sterling was, has actually been, since Brexit, relatively stable. A lot of people underestimate the fact that euro and sterling have been quite pegged, but there was obviously a huge weakening for about 3 days with the political turmoil in the UK at the back end of last year, which Robert might touch on as well. And also just the 10-year rates at the end of the year for Germany and US were significantly higher than they were 12 months previously. And that's the increase in interest rates has been quite significant throughout the year. What are we watching out for in 2023? Well, the first point here is corporate earnings. So far, company earnings and the quarterly earnings season in the US, the numbers have consistently been quite robust. Or what I mean is more robust than one would have expected given the deteriorating economic situation. So watching results on a quarterly basis will be very important. Has inflation peaked? It looks like it has. All signs are that inflation has peaked. And thirdly, what's going to happen in Russia and Ukraine? So I'm going to pass over to Robert now to speak about just some headline points from 2022.
Thanks, Jonathan. Yeah, just I suppose the headline points really for 2022. The top one was interest rates. Beyond the interest rates was inflation. That was the point that everyone was speaking about. But second in line to that was interest rate increases. You can see currently in the EU, it's 2.5%. In the UK, it's 3.5%. And in the US, it's 4.5%. So it was all about central bank interest rate increases at the back end, particularly in the last 6 months of 2022, just to stave off inflation and try to bring it back under control. That was something that was quite prominent in the last 6 months, and it may also feature in the next quarter or two of 2023. And Ian will probably touch on that a little bit later himself. Just moving on to our second point, it was a very strange year for the S&P 500 and US 10-year Treasury bond, because normally they would not be, they would be negatively correlated to each other. But for the first time, as you can see there, in 150 years, both actually fell at the same time and more than 10%, which is very odd because normally one is a hedge for the other. And that did not take place, obviously, because of interest rates, inflation, slower economic growth. All these factors came together in a contagion and actually pulled down the market and created this strange anomaly where we actually saw both falling at the same time. If we look at technology and growth stocks as well, you can see just in the statement there that they were very negatively impacted. They were trading at high multiples during 2022 of what they ordinarily would be. And they've come right on down again towards the latter end of 2022, which was obviously impacted by interest rates again. Consensus that the stocks themselves were overvalued as well during the COVID period of 2020, 2021. So that's actually just realigning the market at the moment where we are back to a normal phase of price to earnings ratio somewhere in the 17 to 19%, particularly for growth in tech stocks. And hopefully that will follow through and level out for 2023. Obviously, in terms of China reopening to the world, that was a bit of a surprise, especially with the about turn that they made. It was a very quick about turn and caught a lot of people unexpected. And there's a high expectation for not only China reopening, actually reigniting the global economy, but also the consumer-friendly Chinese citizens actually making purchases themselves and driving growth, just like they did in post-2008 when they actually ignited the global economy through their own spending patterns and then reaching out into the rest of the world. So that's something to look out for 2023, but that's where we are today in 2022. Who can forget the October mini budget as well, and the political uncertainty that took place during 2022. It was coming from all angles, really, in terms of Liz Truss's action on the mini budget, announcing 45 million worth of tax cuts. That caught the market unawares, and they were very unhappy with it, obviously. Our tenure, as we've spoken about before, was 49 days. And you can see that markets just were not pleased with the budget cuts. Anyone earning over 150K, they decided to scrap the 45% tax on that. And even though it was a small part of the overall mini budget, it was viewed very negatively. In came the Bank of England, obviously having to purchase bonds on the open market. And from there, it was an about turn. And we have Rishi Sunak with us today because of that. So volatility was at an all-time high politically, and it followed through. Obviously, we can't forget the Russian-Ukraine conflict. Dominated the news in 2022 completely. It's still ongoing, although we're hearing less about it. It still is taking place daily, unfortunately. There is talk of there being a peace agreement discussion on the 28th of February. So hopefully that will follow through and we will actually see peace at some stage this year and the conflict end. But that was a huge factor in spiking oil and gas prices. It was a huge drag on markets, created huge uncertainty across the EU. And that's what led to a lot of the volatility that we'll see and that I'll talk about in the upcoming slides. This is the market indices, the full year performance of 2022. As you can see, it was largely a downward pattern as we moved across from January through to December. You'll see that we went from zero pretty much in the 15 to 20% range. This is 9 of the top indices of the world. The FTSE 100 performed very well. You can see there on the right at the top, 0.92% across the year. But the reason for that is because the fund itself is made up largely of energy stocks, which of course we know had a great year because of the volatility, unfortunately. But as you can see, the rest of the stocks traded a lot lower. The MSCI, the S&P 500 down 12.74%, and the Nasdaq 100, all valued in euro, by the way, these indices that we're showing you here, was down 27.95% because that is made up largely of tech stocks and growth stocks, which sold off heavily. If you look at March, you can see the first trough there was the Ukraine-Russia invasion. If you look at July, June, that was the announcement of the Federal Reserve interest rate increases of 0.75%. They were announced on the 16th of June. And then the markets factored those into their equations. The markets rose again. And if you look at October, you can see the market troughed again, which was the mini budget, and could have been an element of the October effect also played into that too, where psychologically the markets expect of all the months in the year where a market could crash, October is the month where it happens mostly. So that also could have been a psychological element to the markets, which didn't obviously help when the markets themselves were turning down and investors were stepping away from equities at the time. If we move on, we have a look at inflation. Obviously in Ireland, I'm going to discuss inflation in the UK, the US, and the EU as a whole, but we just look at Ireland here in December. We were at 8.2%. That was down from 9.2% in October, which for ourselves was a 38-year high, which places inflation in context if you look at it from that perspective. If we go over to the UK at the moment in December, they had 10.5% inflation. That's down from 11.7% inflation in August. If we look at the US at the moment in December, there were 6.5% inflation. That's down from 8.5% inflation in August as well, which for themselves was a 40-year high. If we look at the EU average as a whole, it was 9.2% inflation in December, which is down from 10.1, which was back in September. So you can see the scene in terms of inflation. We're still at highly elevated levels. It's still 3 to 4 times over what central banks would like it to be, which is in the 2% range. So inflation does need to come down, and we're seeing signs, as you can see, of leveling across each of those economies, each of those continents. And we're hopefully going to see inflation continue to go down as the year rolls on. So if we look at the definition of inflation, having discussed where we are from an inflationary standpoint, the IMF has classified inflation as being a measure of how much more expensive a set of goods and services become over a certain period, usually a year, which is how they quantify it. There's other relevant terminology as well that relates to inflation. So we're going to go through each of those, and I'll just give you my opinion on where we are at the moment. First off is disinflation, and I think that's where we are at present, which is where inflation is growing, but at a reduced rate, and it's still higher than economic growth. So we're still feeling the effects of inflation, although, as we said, it is leveling out. We are starting to see it come down, which is obviously because of the impact of interest rate increases across the EU, across the US, across the globe. And we're beginning to see those increases themselves actually slow down. We started back in June, July at 0.75%. We moved then into 0.5%. There's a meeting next month in February. There's one in March. There's one in May with the Federal Reserve and the ECB on the 2nd of March as well. And we expect there to be interest rate increases of 0.25%. So they're going to lower those increases again. And we will see how that plays out. In terms of deflation, obviously that's where prices are falling. And when prices are falling, we're not experiencing that at the moment, but we're in a deflationary environment, you will see that actually economically they'll be suffering there too, because even though prices are falling, it also means that the demand isn't there, and inflation is possibly a little bit overheated in terms of that. So we just have to watch out for the inflationary element of deflation. It's not necessarily a positive or a negative. In terms of stagflation, it's basically an issue where prices are rising at a higher rate than economic growth. We had that for a lot of the latter end of 2022, particularly for the last 4 to 6 months. And now we're beginning to see a disinflationary cycle step into place as the impact of interest rate increases actually lean on the market, as I discussed previously. And then lastly, we have a recession. So that is something that some economies have fallen into already, as we've spoken. There's a lot of talk market-wide about a recession coming into play during 2023. We've heard hard landings, we've heard soft landings. There's converging views across different analysts and markets. And just in terms of a recession, technically what it means 2 consecutive quarters of negative GDP growth. Ireland has avoided that so far. Certain countries, we look at Germany, we look at the UK, and we look at the US, they've come close to that. In the UK and Germany in particular, they're under a lot of pressure in terms of being in a technical recession. but there is still consumer demand. There's still low unemployment in each of these economies. There's still high levels of savings in each of these economies. And we could actually see that it could be a soft landing recession if we were to fall into one in 2023. Possibly Jonathan and Ian will discuss that further. And then lastly, if we look at the US euro over the last 1 year, you can see the chart says it all really in terms of volatility. You can see it's just going downward all the way throughout the year from January through October, and then the US splitting off against the euro. So it's just been a case of high volatility throughout the year. The euro was actually a negative parity to the US dollar there in July. On the 5th of July, it fell below the US dollar for the first time in 20 years. As you can see, because of the EU volatility, because of conflict, because of investor trepidation, because of slowdown in economic growth, everything just seemed to come together in a contagion. But since then, things have picked up with interest rates in the dollar. Obviously, it's become more attractive. I'll pass you back to Jonathan now for the market outlook.
Thanks very much, Robert. That was very insightful. And just one point that I'm sure people who've been on our previous webinars have heard me say before is the Goldilocks scenario. So not too hot and not too cold. And the primary objective of central banks is to have an economy growing and inflation running at a rate that's not too hot and not too cold. So the optimum growth and inflation rate is about 2%. So that's what all the central bankers are saying. Yesterday, both the ECB and the Fed said that they want to get rates or inflation back to 2%, and they will do what it takes to bring inflation back down by increasing interest rates. So what Robert mentioned there about deflation, that was a risk up to about 2 or 3 years ago, where individuals and central banks were worried that prices were falling, and that is as dangerous as inflation. So that what they want is stability, and that's all that's happening at the moment, is that coming out of COVID, coming out of the Russia-Ukraine, coming out of cheap money for 10, 12 years, we're experiencing this level of inflation. I wouldn't say it's unprecedented, because anybody who lived through the 70s and the 80s in Ireland experienced inflation. But what we are seeing is this inflationary risk. I suppose one positive from Ireland's point of view is that because we're in the EU, it's more stable. Robert mentioned there the rate of inflation in Ireland is 8.2%. I think it's about 9% or so in Europe at the moment. But it's amazing how the rate of inflation is quite similar in Ireland as it is in Germany and France and Portugal and Spain. Whereas back in the 70s and the 80s, when Ireland was in the punt, and you know, we were a lot more susceptible to interest rate shocks and currency volatility. So at least there's more stability now in the euro. Just looking at some asset classes here. So interest rates, so you know where we're at, they're continuing to increase. This affects you guys in terms of deposits and also in terms of interest on loans. So interest rates are increasing, albeit not at as high a rate as we've experienced last year. So Irish banks are not paying the rates that they should be paying on deposit. And the reason for that is competition, because we've lost KBC, we've lost Ulster Bank, and the remaining banks are saying, well, you know, what's the alternative? So I do expect a bit of political pressure and focus to be on the Irish banks to start increasing deposit rates, because at the moment it's negligible, whereas some of the European banks that we deal with are offering, you know, 1.5 to 2% on fixed deposit for certain amounts over certain thresholds. So I would expect both the post office and the Irish banks to increase deposit rates. But remember, the rate of interest on deposit is always going to lag inflation anyway by a small amount. Then you factor in dirt tax and PRSI on the interest, so it's always going to be that bit lower. But nevertheless, for any funds that remain on deposit, it's always important to get as much of a deposit rate as possible. We are seeing bonds come back into vogue a bit, because with interest rates increasing, unfortunately, bonds as an asset class sold off significantly in 2022, but it has meant that for fresh money, bonds have now become more attractive. So, you know, ultimately up to a couple of years ago, there wasn't much of an appeal of bonds, whereas that's becoming more attractive now. What can I say about equity markets? You know, in my 15 years, managing money and looked at markets, more than 15 years, I've never seen such volatility and uncertainty. any clients of ours on this webinar will be sick of me saying the analogy that, you know, on a 6-month basis, if you asked any of us here in Compass, what's our view on where equities would be, will they be up or will they be down? It's a toss of a coin. It's a 50-50 chance. You ask the same question over 12 months, you probably have a 52, 54, 56% chance of being positive. And this all goes into timing. If you ask on a 10-year view, will equity markets be higher than what you would get by keeping money on deposit? The chances go up closer to, you know, 90, 95%. So it's time in the market, not timing the market. If you have funds that are allocated for investments and you don't need those funds, you therefore have, say, a 5 to 10-year time horizon on them. It kind of doesn't matter the level of volatility unless you've got stock specific exposure. But if you're in the type of assets we manage where you're, you know, long-term focused funds, the short-term volatility shouldn't matter. It's time in the market, not timing the market. And we have seen a lot of negativity with alternative assets. So it does go to show, you know, with cryptocurrency and Bitcoin and all the FTX thing that went on last year, that, you know, before you ever take advice on what's a hedge, just be mindful that, you know, sometimes when markets sell off, there is no real place to go. And a lot of these supposed alternative things like crypto and unregulated assets are a lot more dangerous than the regular asset classes. So what we've talked about so far is investment markets in terms of what happened in 2022 and what's going to happen in 2023. And Ian will discuss from the perspective of Zurich what they feel the headwinds and the tailwinds are for 2023, but what it means for financial planning. Okay, so the first thing is that, you know, as Robert said, we are entering a disinflationary environment. It's still inflation, prices are still higher, they're just not rising by as much. So we're advising all our clients just to be very, very mindful that when you're budgeting for 2023, all else being equal, the price of your living costs is going to be higher than it was in 2022 and higher than 2021. So just be mindful of that when you're making financial planning decisions. Also be conscious of things like interest rates on borrowings and making sure you're looking at fixing. We deal with mymortgages.ie down in Cork for all of our clients who want to, you know, switch their mortgage and look at what the various rates are at a point in time. And now it's very important because we're in this inflationary cycle. So things aren't stable. And when things aren't stable, you need to kind of roll up your sleeves and make these financial planning decisions. Interest rates is going to be a big theme, so we have to be conscious of it. We didn't have to think for 10 years. We really didn't, because we were in this benign low interest rate environment. Anybody who had a tracker rate from the 2000s was sitting pretty. They weren't paying any interest. Borrowings didn't have to be repaid because interest rates were so low. As the prices were increasing, the property market increased in Ireland, but we are in this pattern now of increased interest rates. We have to think about asset allocation a lot more. As I said earlier, time in the market, not timing the market. So we do have to think absolutely long-term at all times. So long-term view beats volatility and diversify. Now, you could say to me, Jonathan, it didn't matter that we were diversified in 2022 because equities fell and bonds fell at the same time. And I take that point because, as Robert said, it was the first time in 150 years where both equities and bonds fell by more than 10% in the US. But look past that, the more diversified you are, the more stable your returns will be over the long term. And genuinely, the idea of putting all of your assets with one manager, in our opinion, into one fund or one style doesn't make sense. It's always worth diversifying as much as possible to lower your downside risk. So now I'm going to bring in Ian Slattery from Zurich. Ian, thanks for joining us this morning. And you might just talk to us, just introduce yourself and tell us a bit about Zurich and and you can go through your couple of slides then.
Yeah, thank you. Good morning, Jonathan and Robert and everybody on the call. Thanks for having me. Just want to chat through a few bits and pieces, but by way of background, my name is Ian Slattery. I'm head of investment solutions with Zurich, based in Dublin. And we manage about 30 billion euro for Irish savers, pension investors, and people with investments. So we manage money actively. We manage money locally here in Ireland. So very much giving you kind of a brief snapshot in terms of our views of the world and markets last year and this year. We produced plenty of investment commentary, and I'm sure Jonathan, Robert, and the rest of the team will be able to, for anyone who's with ourselves or is thinking about it, be able to put you in touch with some of the various documents. I've 2 slides, and I know this picking up on a theme that's already been discussed so far is this idea of negative bond yields. So when you have a negative bond yield, if you have a bond and you hold it to maturity, you have a negative return unless you see the price move up significantly. So what this is showing you is the stock of negative yielding bonds in the green line. And it's interesting that you had at one point 18 trillion with a T, of bonds that were negative yielding. So really, really low asset prices in terms of, or really high asset prices with really low bond yields across the globe. The Bank of Japan were the last holdout, the last major geographical region that was continuing with this low interest rate, low yield environment. And they've made some changes in recent weeks as well. So you now have a point where there's no negative yielding assets in terms of bond markets today versus trillions just 12 months ago. So just another way of maybe making the same point that has already been said in and around the big changes for bond markets. And this is the idea, obviously, as we can see, all 3 of those lines are trending down over the last 12 months, both in terms of the MSCI World, the idea of the big stock market, the Bloomberg aggregate Treasury Index, which is the bonds, and then another way of talking about the red line is to talk about the green line as well in terms of the negative yielding assets overall. So very, very big change for markets in relation to bonds. Why do we think that is important? Bonds haven't really been at the table in terms of a real live decision or option within multi-asset funds for the last couple of years, within our opinion at Zurich. But as Jonathan was saying on the last slide, diversification is really, really important, even though it didn't really work to its full extent in 2022. And it's actually quite a good opportunity now looking forward that bonds are back in positive territory due to the higher interest rates, and they're a live option for investment managers as well. I think it's really, really important to reiterate one of the points Jonathan mentioned. You might see deposit rates start to tick up in terms of the headline rate from 0 up to 0.5 or 1% per annum, but always remember your real return. Okay, so that's the most important thing, and that takes account of inflation. So if you get 0% on deposit and inflation's running at 0%, as it has at times in the last decade, you might be comfortable with that. But just remember, even if deposit rates go up to 1%, if inflation's at that 8 or 9% figure Jonathan referenced, that's a real negative real return of 7-8%. So I think it's always important to chat to the guys at Compass, chat to the team if you're looking at any kind of deposit kind of related investments. That's a little bit of looking back. If I was just to look into 2023, we have the kind of the bulls and the bears. So for anyone who's not too familiar, I suppose the bull is the good times. The bull is the tailwind that might help markets. And just to kind of run through them, this is the thinking from Zurich, and maybe some of this might prompt some questions if anyone wants to ask in questions in the Q&A. But we got China. China has followed this zero COVID policy for the last number of years. We've seen some social unrest within China in recent months by people kind of protesting against this zero COVID policy. And we've seen a reversal from Chinese authorities in relation to that. Putting aside COVID as a societal and medical issue, which it is, of course, first and foremost, but looking at through an economic lens, we actually see reduced industrial production, reduced economic activity in the Asian region because China was doing these sort of lockdowns. So overall, a positive for the Asian economy and therefore the global economy if we see the zero COVID policy being rolled back in China and a return to higher economic activity. I think it's in our time in Zurich, it's probably, if a recession does materialize, it'll be the most forecasted recession of all time. Everybody's expecting a recession. Now, what I will say about a recession is stock markets are always forward-looking. So when a recession materializes, stocks have tended to bottom out 3 to 6 months in advance historically. Okay, so they're looking forward, they're seeing what might happen with a recession. But however, if we do get a recession, it might be very shallow or it might be avoided entirely. Okay, so people have an expectation of a recession in parts of the world that might come out to be better than expected. I think in terms of inflation and interest rates, higher interest rates in general are not a problem. There are periods in history where inflation and interest rates were much higher than they are now, historically speaking. the 70s and 80s, as Jonathan mentioned, would be times like that. I think the importance, though, is if rates stabilize. If investors get a concrete view and they're pretty comfortable that they have a credible consensus of where rates will be in 6, 12, 18 months' time, even if they are at a higher level than they are now, it's the certainty that markets would enjoy from that. Another point as well, the last one, and this is actually particularly true in Ireland, and I do fully accept that averages, half the people are above it and half the people are below it, but there is still quite robust consumer savings. So a lot of people, not everyone, but a decent proportion of people in Ireland and globally were able to save quite well during COVID. So when you have a cost of living crisis, when you have higher input costs and higher costs in general, you start to spend down those savings because you need to dip into them a little bit more. However, the consumer, if I can call that a collective, has remained strong so far in 2022. So again, bringing it right back to basics, when you're investing in equities, you're hoping people buy your products, you make higher revenue and higher profit. So the idea of a strong consumer is really, really important. To look on the other hand, like anyone with an economics background always tends to, in the bear case, these are the headwinds. These are things that might trip up markets going forward. So we're kind of not fully beholden, but quite a lot now we're hearing about what is Jerome Powell in the Federal Reserve saying, what is Christine Lagarde in the ECB saying, okay? So a policy misstep is a big risk at the moment. What I mean by that is if we see rates raised too quickly from the current level or not raised enough from the current level. Central banks, in terms of their monetary policy, are trying to walk a tightrope in terms of bringing inflation down, but avoiding that really, really deep, severe recession. So a policy misstep, it's quite idiosyncratic. It's hard to forecast. It's quite binary, but it's always one to have on the radar. This idea of stagflation, okay, what that means is we have high inflation, but not a low economic or stagnant growth. So high inflation, stagnant growth, stagflation. So that's a bad scenario for the global economy. As I said already, inflation isn't a bad thing if you have some sort of view and you have a credible view and you have a certainty in terms of the outlook. And inflation isn't a bad thing if it comes with commensurate economic growth. However, high inflation with low economic growth exasperates or exaggerates the issues for consumers. So again, that's a tighter one. In relation to financial conditions, this again feeds directly into what we're seeing from central banks. So the idea of financial conditions, think about lending criteria, think about underwriting, things like that. Credit's just that bit harder to get. So particularly in Asia, we saw tightening of credit, we saw tightening of financial conditions that would have a negative effect on overall economic growth. The fourth one is probably a little bit more long-term, and it's been building for a while. Okay, so you see the vote for Brexit, you see the vote for more nationalistic figures like Donald Trump in the US, irrespective of you think of your politics. You see the breakdown of global supply chains throughout COVID. We've seen this great period of the great moderation is how it's been coined of increased globalization, which started or was accelerated by the Chinese entry into the World Trade Organization. What we've seen since COVID is a little bit of onshoring rather than offshoring. Okay, the idea of having national control over medical supplies, over food stores, things like that. Can argue the pros and cons of that as a concept overall, but net, deglobalization would be a problem for economic growth. Globalization, laws of comparative advantage, these sort of phrases are good for globalization, is good, and it's good for economic growth. So look, a very quick snapshot on the Bulls and the Bears case. It's a bit more finely poised than it has been in a number of years. It's quite a pivotal year, we believe, in terms of inflation expectations, where we might go. Before we go to Q&A, just to echo some of the points, I do firmly believe the value of financial advice at a time like this, about sticking with a financial plan. Your fund choice and your plan 12 months ago, the world might have changed a little bit, but if your own personal circumstances haven't changed massively, you still may well be on the right path in terms of your financial plan, but it's always just worth checking in with Jonathan and Robert and the team. So a whistle stop tour, Jonathan, but happy to kind of elaborate on any points or pick up any questions that might come through.
Ian, thank you very much for that. That was very, very interesting and insightful. So now we've got about 5 minutes for Q&A. We've got a couple of questions have come in already. The first question I'm going to put to you, Ian, and it actually ties in with your fourth point in the bear case, and it's in relation to like the US government deciding to encourage US companies to shorten their supply chains and move manufacturing away from China and bring it back home. So how do you think that's going to impact on, firstly, the US economy, secondly, the Chinese economy, and thirdly, global trade and markets?
Yeah, big question. We've seen it play out, this idea of semiconductors, which are an important input into all electronics, essentially, and the Biden administration. It's kind of gone under the radar a little bit. So whoever asked the question has certainly been paying attention about this idea of onshoring those supply chains. It's hard to know net how this works out, right? Because you're going to see overall some advantages to certain areas of the US economy in terms of jobs when these things come back, but you're going to see higher input costs to other areas of the US economy because it will more than likely cost more to produce or to do this manufacturing in America than it would be in the Far East. So I think overall there will be winners and losers, as there often is when these things happen, but I do believe from a purely economic sense, putting aside politics or security concerns, etc., it's not good news for the global economy if companies and countries aren't as efficient as possible as they can be with their supply chain. So it is a worry. It's hard to grasp. It's not that tangible. It'll take time to kind of wash through, but it's something that's kind of occupying our minds essentially for the rest of this decade.
Thanks, Ian. And I'll direct this question at Robert. The question is, which quarter in 2023 would you predict interest rate increases? That might be a bit too specific, but Robert, yeah, if you could just comment on, we've kind of discussed the interest rate cycle in 2022, but what you expect in 2023 and whether or not you think there could actually be interest rate cuts maybe at the beginning of 2024 because central banks will have been so aggressive.
Yeah, no problem, Jonathan. Yeah, I alluded to it earlier there as well, just in the commentary before when we looked at the interest rate slides. It's generally perceived from an analyst standpoint, just across various asset managers and fund managers across the globe, that there should be 2 to 3 interest rate increases broad-based across the US, the UK, EU as well, somewhere in the increment of 0.25% in each instance. So there should be a topping out for the US of another 0.5%, maybe 0.75% increase. That's what's perceived at the moment. In terms of the EU, we should see again a 0.5 or a 0.75% increase, maybe a 1% increase, because the EU actually has to do more work to catch up with the US. They've actually moved ahead to be more aggressive with their interest rate increases. So it just depends really. There's a meeting obviously with the ECB and the Fed next month, and then in March, and then in May again. At each meeting, it's expected that they will increase interest rates at 0.25% in each, but they may actually surprise markets. They may not increase. They may increase slightly quicker. They may go for 0.5% increase initially. So everyone's waiting with bated breath for that. In terms of actual decreasing interest rates, it's perceived that in Q4 or Q1 of 2024, that's when we could actually start to see interest rate decreases.
Thanks, Robert. And one other point on that is that the central banks need to have a big bark as well as a big bite. So if the central banks came off and said, yeah, things are cooling down, so we're probably not going to increase rates as much, then that'll lead the economy into changing direction. And the market and the economists and CEOs and governments look at what the central banks say so closely. So there is an element of a bit of, I wouldn't say bluffing is the word, Ian, but they have to be robust and they have to kind of look at the camera and say, if you see Jay Powell in the US or Christine Lagarde, they have to be very, very firm and talk down or talk up interest rate increases, and to really, really make the world know how serious they are about bringing down. So whether or not they'll actually follow that through with interest rate increases, we really don't know. We have one other question here. Well, we have a few other questions, but we have time for one more question, which I might just take and ask you to comment, Ian. It's asked about the dollar, and will the dollar strengthen 2023? Now, with a question like that, I suppose it's probably the most difficult question in economics and markets, because when you look at the euro versus the dollar, there's so many factors that could affect it over both the short term and the long term. It could be a case of the dollar strengthening or the euro weakening, or the other way around, the euro strengthening relative to the dollar. So we kind of, as a firm, never really have a view on it because it's impossible to know in the short term. The one thing I would say is that if you are an Irish investor and you want to diversify your portfolio, it is inevitable that you'll have to take dollar exposure because the US market accounts for about 60%, so 3/5 of the MSCI World Developed Market Index. So unless you want to, if you want to ignore the dollar, you have to be overly concentrated in Europe or inevitably into sterling or Asia or whatever it might be. And the one thing to remember is that if the dollar does weaken, and say the dollar goes to 120, the earnings that US domiciled companies report, to the extent that those earnings are outside of the dollar and say in euro, they're going to be stronger in terms of their earnings because the dollar is weaker versus the euro. The euro earnings for the US companies will be a bit stronger. So it's not as simple as the dollar depreciates by 10%, my US investments decrease by 10%. Ian, I'm not sure, do you want to comment on the dollar and
yeah, we can probably be a bit firmer with having a view, so because we do have one. So just to start at the end of your comments there, I do think currency is always important. Just as you said, the concentration of global assets everywhere, not just the explicit US market, but you've got the Hong Kong dollar pegged against the US dollar. You've got the likes of Australia and Canada, which are based on commodities priced in US dollars. So it is, the dollar is king, and we've seen that particularly over COVID. Two things maybe just in relation of the potential direction is the dollar would tend to weaken as economic growth or sentiment gets better because it's seen as a safe haven. So if you're a bit worried, you might move your money into dollars, which strengthens the dollar. So if things look a little bit brighter, that would mean generally speaking, a weaker dollar. The second point is something both Jonathan and Robert said there as well, is we'll see a bit of a divergence in central bank policy in 2023. Like last year, everybody was raising rates, and it was just kind of how fast they were going to do it. To accentuate Robert's point, you'll get now at some point in the first half of the year, the Fed will be finished, in inverted commas, their rate rises. Europe mightn't be there just yet. So people's view on currencies based on the interest rate will start to differ as well. So generally speaking, the dollar got below parity for the first time in a long time against the euro late last year and has weakened a little bit further. It's very, very hard to predict FX markets. It's the hardest asset class again. I know Jonathan mentioned that. There's so many variables. But from this point, it's more likely than not you'd see the dollar weaken from here as opposed to strengthen, but nothing's guaranteed, of course.
Okay, well, look, we have a few unanswered questions, but we will, if anybody wants to email us afterwards, please do. A big thank you to Ian, thank you to Robert, and thank you to all of you for joining us this morning. I know your lives are all busy, so we really appreciate the time. If you missed any parts or you want to look over any of the slides, we'll send a recording, we'll send the slides. We're open for business, as you know, so if you want to discuss any future planning or send a presentation on to anybody else, any friends or contacts of yours or colleagues, please do so. And thanks again for your time, and we look forward to seeing you soon.
Thanks, everyone. Cheers.